Hi, welcome. Today we're going to discuss economics, the second module, which is on microeconomics. Looking at the paper, question 1, choose the correct word from those given in brackets. 1.1, a positive or a negative externality, the private cost of production is less than the social cost of production. A positive externality is a situation where the community benefit not necessarily directly from the production of the product, but from the improvement in the infrastructure and the creation of jobs in that specific community. A negative externality is how people are affected in a negative way by the operations of the business, and this could include things like pollution. Now, in this specific question, they refer to the private cost of production is less than the social cost. That means the cost to the individual or the business is less than the cost to society. The answer is negative, and I'm going to underline it. Question 1.2. Governments intervene and ensure that sufficient quantities of staple foods are produced by setting minimum or maximum prices for these goods. Now, there's a little bit of a problem with this question because the answer can actually be minimum or maximum, and I saw on the memo that they accepted both of these answers. The reason why minimum is the correct answer is that when you look at the price of labor, you would like to set minimum prices for labor to protect the laborers or the workers. But when you look at staple foods and you look from the side of the producer can only charge a certain amount of money, which is then the maximum price, to enable people to actually afford that staple food. So I would say maximum is the best possibility, but in the memo they actually accepted both. Question 1.3. The shape of the demand curve for a monopolistic competitor is the same or not the same as that of the monopolist. The important thing here is that you need to understand the difference between the monopolist and monopolistic competition. With the monopolist, there's only one supplier of the product, and the product is unique. So it's very difficult for other people to enter the market or other businesses to enter the market. With monopolistic competition, you have a large number of suppliers of a very similar product. And because you have these differences between monopolistic competition and the monopolist, your answer will have to be not the same. 1.4. When the product mix does not reflect the consumer's taste, it indicates a or an productive or allocative inefficiency. It would not be right to choose the word productive, as productive is an indication of the production process and how they manage to be productive in that production process. But if the consumer does not get the product that he needs, the problem will be allocative. Therefore, I'm underlining that. Question 2 lists 3 ways in which the government can use tax revenue to reduce the unequal distribution of income. Now, already when they charge these taxes or they levy these taxes on a person's income or on goods and services, people will pay different taxes depending on their income. So income tax will be different. That is a progressive form of taxation based on your income. Now, what they want to know is once they've received that income, so it says how will they use tax revenue to reduce unequal distribution of income. That means that they have to do something else when they receive that income. And I would suggest that they pay out subsidies to help businesses to reduce the selling price of the product. They pay out grants and pensions. And I want you to go in and investigate other ways in which the government actually look after the people that are in a poor financial position. For instance, low payment on education or free hospitalization. Question 3, study the graph below and answer the questions that follow. Now, before we start answering the question, I would like you to look at a few things in this graph that will help you when you start reading the questions. To start with, we see that we are working with a monopoly. So what do we already know about the monopoly? The monopolist has a unique product. And because it's unique, there is no close substitutes. The other thing that we see is we know that profit maximization in any market takes place where marginal cost equals marginal revenue. So I'm going to write that here at the top. Marginal revenue equals marginal cost. And that would be, when I look at this graph, at point A. Right, I think we are ready to move on to the actual question now. 3.1. Which point on the graph indicates optimum production? Optimum production will be at point A, as we indicated, where marginal revenue equals marginal cost. So in your answer, you can actually either write point A, or you could write marginal revenue equals marginal cost. Question 3.2. Describe the nature of the product supplied. What we've already indicated is that this is a monopoly, which means that there's only one supplier of the product. So in your answer, you can actually indicate that it will be a unique product. And that means that there will be no close substitutes. And you can write any one of these two answers. Question 3. Still working with the same graph. 3.3 is the firm making an economic profit or economic loss. You have to show all calculations. When I look at the graph, I can see that because it's a monopoly, they're actually selling their product at 80 Rand. And that means that they are making 20 Rand more than the normal profit. So if you have to calculate this, I just want to show you on the calculator. The difference between 80, which is your economic profit, and 60, which is the normal profit, will be 20. In this case, the quantity indicated on the graph is 200. So you have to multiply it by 200 to calculate your economic profit, and the economic profit will be 4,000 Rand. When you answer this question, make sure that you know that it consists of two parts, because the question initially asked, is the firm making an economic profit or an economic loss? Your answer will be economic profit. And when you have to show the calculations, you would indicate your economic profit will be 80 minus normal profit, that will be 60. And that would be the economic profit that you make on 1 unit. But as you can see in the graph, they are selling 200 units, so it has to be 200 multiplied by 20, and your answer will be 4,000 Rand. So the economic profit will be 4,000 Rand. We'll go into an ad break, and I'll see you after the break with question 4. Welcome back. I want us to now look at question 4. The instruction here is study the cartoon below and answer the questions that follow. It specifically says study the cartoon below. So before you read the questions, make sure that you understand what is actually happening in the picture. When I look at this picture, the first thing I see is a big hand. I see the word cartel. So the first thing that I think of is oligopoly. Then I see price fixing. And I'm sure that you've all heard in the news that some price fixing has been taking place over a number of years in the country, and that the Competition Commission is actually checking up on these people, following up and making them pay fines when they break the law. Price fixing is also something that will happen in an oligopoly. Then the next thing that I see is a bread machine that is actually slicing up a person. So this person must get hurt or injured or something during this process. And then I also see that this person represents the poor. So how will price fixing by the oligopoly injure the poor? What effect will it have on the poor? That's when I look at this thing, what I think the question could look like. 4.1, identify the market structure in the above cartoon. Because you've studied the cartoon properly, you can now with confidence say that the market structure will be that of an oligopoly. I studied the memo as well, and I saw that they also accepted the imperfect market. But it's very clear when you look at this that it is actually an oligopoly. So you can be more specific in your answer. 4.2. Describe the message expressed in the cartoon. Now we looked at the cartoon, and I actually want to go back to the cartoon. And we saw that when the cartels or a group of producers that actually work together to fix prices, when they do that, and especially because we see that this is the bread machine, the machine that cuts the bread, the damage is done to the poor when they do price fixing, because usually when they fix the prices will be higher than the normal market price, where the prices are determined by demand and supply. So the answer to 4.2 would be that it is damaging to the poor. Or harming. Because as prices go up, the income will not increase, and they already operate on a very low income. So any increase in the price of their staple food will definitely harm them. Question 4, still on the cartoon. 4.3, how can a firm in this industry increase its market share? Because the oligopoly does not have that much control over its prices, they need to do something else to increase their market share. In other words, to get more people to purchase their product. And they are going to make use of non-price competition. So if you write non-price competition, you should get your 2 marks. I suggest that you actually write an example as well. Non-price competition could include something like door-to-door sales, it could also include anything that makes it attractive to the consumer. For instance, free delivery, or a free newspaper when you fill up your car. So the price of the product doesn't change, but you do something else that will encourage the consumer to purchase your product. Question 4.4, name any 2 industries that have been investigated by the Competition Commission for price fixing in South Africa. Okay, in South Africa we've had price fixing in the field of food, and more specific, bread. Then there's also been issues in the field of fertilizers, milk, and medicine. And if you go to the complete memo, you will actually see a number of other industries where the same type of thing has happened. Question 5. Briefly explain the rationale of cost-benefit analysis. this implies that the owner of the business must sit back and decide whether taking on this business is actually going to be really worthy by looking at all the expenses or the costs and all the benefits that will come from the specific operation. I'm going to show you the memo. So that we make sure that we don't skip anything and that you can be sure of what exactly you can include in a question like this. Cost-benefit analysis, that's the abbreviation CBA, helps to make better decisions on how scarce resources are allocated to satisfy wants. Because in any situation where you decide to start a business, you have to look at the opportunity cost. In other words, if I decide to produce a certain product, I'm sacrificing possible income on producing something else. Okay, so we're looking at, and this is one of the issues with economics, the fact that we have limited resources and unlimited wants. Scarce resources are allocated to satisfy wants. So and it helps us to make those decisions. It involves making decisions based on comparing economic benefits. So how will we benefit the profit that we're going to make, or the cost of the project? What are the expenses that we are going to have? And those costs could also include costs to society. The feasibility of the project is determined by subtracting costs from benefits, which means you're going to say feasibility. In other words, is it worth it to take on this project or not? Would be benefits minus costs. And obviously you need a positive answer to be interested in actually following up on this project. If the difference is positive, benefits are bigger than costs, then the project will be undertaken. Besides efficient use of resources, cost-benefit analysis also ensures the right combination of goods is produced. And this will go back to your production possibility curve that you worked on in grade 10 and 11. Also provides us with deciding alternate solutions to specific problems. In other words, I might decide to produce a specific product, but I need to decide what the method is going to be, which one is going to be most beneficial to me, in which one can I actually maximize my profits. And therefore, they also indicate here, thus, a project that maximizes benefits compared to cost should be chosen. So you want to get more benefits than costs from this operation. There's a need to consider the time value of money because the project will only occur in the future. So now you have to determine if this is going to be the best investment for your money, because you will actually only see your profits in the future, as the project will only take place at a later stage. Therefore, future benefits and costs are discounted to present value. So you have to look at the value of the project at the moment, and you have to try and predict what the value of the project is going to be at a future date, because you have to take things like inflation into account. In the market economy, resources are allocated through the interaction of demand and supply in the market. So when you operate in the market economy, the selling price will be determined by what is supplied and what the demand from the side of the consumer will be. Just going to underline interaction of demand and supply. And what this means is that when you look at a graph and you have your demand and supply curve, your market price is determined where the demand and the supply curve interacts. Decisions by people, businesses, and governments are important for the society. It involves the allocation of scarce resources. So when you start this type of business, you also have to look at what the feelings of the community is going to be about that specific project. Because if it is something that is going to be damaging to the environment, something that they do not want in their community, it might not be such a good idea. So allocation of the scarce resources, make sure that those resources are used in the best possible way. In other words, productively. Right combination of goods and services produced to satisfy the needs and the wants. So also look at what the needs and the wants of the people in the community would be. The last point brings objectivity to decision making. Instead of just starting the business, if you actually collect information, ask the people in the community, ask people who have knowledge on that specific project, it will help you to be more objective. So you don't just do it for the sake of the profit. You actually look at what the social cost and what the implications of this project is going to be. Identify the relevant benefits, and that would be benefits to you as an individual. So that would be private benefits, and also to the community, in other words, social benefits, including the cost to you as individual, but also the cost to society. And then it says, and quantify them in terms of money to make informed decisions. Question 6 is the last 8-mark question. As you can see, the breakdown for this question is 2 marks for 4 different facts. The question says, discuss the aims of the competition policy in South Africa. So you need to know a little bit about the competition policy. And the reason why we have a competition policy is because sometimes competition can actually get out of hand and be harmful to both producers and to the consumers. The reason why we have it here is to prevent the abuse of economic power. In other words, sometimes you get a monopolist that abuses his power by charging such high prices that the people who need the product can actually not afford it. To regulate the growth of market power. So when we look at the growth of market power, we have to be careful and be aware of the fact that some people might be increasing their share in the market and in that way gain control over the market. And that could be done by means of takeovers and mergers. So I mentioned those 2 examples specifically. To prevent restrictive practices. Now, when you see the word restrictive practices, that means making it difficult for people to either enter the market or for people to afford the product because of price fixing, as you see in the case of the oligopolists. So especially by oligopolists, like fixing of the selling prices, collusion, that's similar to fixing the selling price, where the oligopolists actually work together in respect of tenders or price discrimination. The term price discrimination, just to refresh your memory on that one, where people in different groups are charged different prices for the same product. For instance, a luxury product might be more expensive in an area where they know that people earn a higher income than in areas where people earn lower incomes. To contribute to the developmental objectives of the state, you can indicate your own example. But the idea behind this is that the government wants to achieve certain objectives. For instance, they want full employment. They want the inflation rate to be more stable. They want to encourage exports. Those are just some of the objectives. So you can mention that as an example. So if they want to encourage exports, for instance, they might apply that through changes in the competition policy. To improve efficiency of markets through legislation. So in other words, regulate prices by implementing minimum prices on certain products to protect the producers in that specific industry. To improve equity in the markets, I just want to highlight the efficiency, to improve equity in the markets. When you look at equity, that means giving everyone a fair chance. And this could be done through the Employment Equity Act. That is an example. To protect the consumer against unfair prices and inferior products. Unfair prices might be charging too much for a product that's not really worth that much. Or inferior products are those type of products that do not really deserve to get a high price. We're going into an ad break, and when I come back, I will discuss question 7. Welcome back. We're now going to look at question 7, which is the essay on microeconomics. Question 7. Use graphs to analyze the various short-run equilibrium positions for an individual business in the perfect market. Keywords that I would like to identify in this section would be the fact that you may have to make use of graphs, that you have to look at the short-run equilibrium positions, and that you are looking at the individual business in a perfect market. So when you start discussing this essay, it would be a good idea to, in your introduction, indicate exactly what the perfect market is all about. I want to remind you that when you write this essay, there's a specific breakdown that you have to follow. Your essay consists of an introduction, a body, and a conclusion. The introduction is worth 3 marks and will usually be a definition of the concept that you are going to discuss. In your body, it is advisable to answer in point form, although it must be full sentences. So you don't write paragraphs, and you make it very clear what the different points are that you're actually discussing in that essay. This is an example from the memo of what the introduction may look like. The perfect market is a market structure which has a large number of buyers and sellers. This is one of the most important characteristics of the perfect market. Because the owner of a business in the perfect market cannot influence the price, this person will be known as a price taker. Sellers are therefore price takers. And then it says, accept any relevant definition of a perfect market. The important thing is that even though you don't have to write exactly these words, we would like to see large number of buyers and sellers not able to influence the price. Those type of keywords must be included. Moving on to the body. As an individual business in the perfect market, you know that you cannot influence the price of the product. So how would the prices be determined? It would be determined by the interaction of demand and supply. That is worth 2 marks. When you draw a graph on how prices are formed in the perfect market, it will indicate the intersection of the demand and the supply curve. Make sure that you label everything properly with quantity at the bottom. Where the equilibrium is, that is where the prices will be, or the market price will be. So when you refer to something like DD, you actually have to draw a graph and indicate what is this DD that you are referring to. So DD, or the demand curve, slopes downward, as you can see on the graph, from the top left to the right bottom. And the supply curve, SS, slopes upward from the left to the right. The reason why the demand curve slopes downward from the top left to the right bottom is because at a high price, more will be demanded, and at a low price, less will be demanded. Exactly the opposite happens with supply. As a producer, if you see the opportunity to make more money, you are going to be willing to supply more. Therefore, we say that at a high price, more will be supplied, and at a low price, less will be supplied. Individual businesses form a small portion of the market. So as the owner of this business, you have such a small impact on the market that it doesn't even make a difference. So a small portion of the market, and it does not influence the market price. Remember, the closest that you can get to a perfect market is the sale of shares. If you want to buy a share in a business, it doesn't actually matter who you buy the share from. The share will be available at a specific price, and there's no discrimination. So whether you buy it from this person or the next person will not make a difference. So because of that, you cannot decide your own price. That's why they say, won't charge a higher or a lower price. And the reason for that is that people will just not support you. They will buy the product from someone else, or the share in this case. When we look at the graphs, take note, and when you draw these graphs, make sure that you use a ruler and that you label your graphs properly. What they've done here is they've indicated the industry on the left-hand side. In other words, what does the demand and supply curve look like for the industry? prices are determined by the interaction of demand and supply, and therefore you have your demand curve, you have your supply curve, and you have the equilibrium. So this will be your market price. As an individual, you have no control over the price of the product. So as you can see here, the price stays exactly the same, no matter what the quantity. Quantity 1, the price is P1. Quantity 2, price P1. Quantity 3, price P1. So you have to take the price, and the only thing that you can actually do to increase your income is to supply larger quantities, because you still have to sell it at the same price. And what you will see here is that the price is equal to the average revenue and equal to the marginal revenue. Be sure to label your graphs properly so that it's clear which is the industry and which is the individual business. Okay, the discussion on this is for each unit sold, the business receives the same price. Therefore, P1 equals AR equals MR. The economic cost is the same as opportunity cost, and it's also equal to explicit cost plus implicit cost. Explicit costs would be those costs that you can clearly see are involved in the production of the process or the product, and implicit costs would be those things that are not directly related to the production of the product. Okay, so explicit cost, expenditure on wages, interest, leasing of land, raw materials. Implicit costs would include value of the inputs owned by the entrepreneur plus what is used in the production process. That would be forfeited rental, interest, and salaries. Now moving on to the next part, the role of the individual business. Production, profits, losses, and supply. How do I discuss that? In other words, if I have this as a heading, I do not repeat what I have in my heading just by putting it in a sentence. I have to elaborate, and I have to make it clear by making use of an example. Maximum profit for the individual business. Where would the individual business maximize its profit? The horizontal line at market price. To obtain maximum profit, the market price plus the own cost structure is taken into account to determine the production output. You can write either one of these two sentences. Once again, where do we maximize profit? Where marginal revenue equals marginal cost. In this example, the horizontal demand curve represents marginal revenue plus average revenue. Those are the 2 points that I referred to. Maximum profit is the point of intersection of marginal cost plus marginal revenue. So that's going to be point E. To the right of E, in other words, to the right of quantity 3, in other words, in this area. Production cost exceeds revenue, so it will be more than. And there we see the sign, marginal cost is bigger than marginal revenue. So if you move to quantity 3 or above quantity 3, then you will actually make a loss. Point E, as we indicated on the graph, is where profit is maximized. That is the equilibrium. It is therefore clear that profit maximization in the short term, in the perfect market, will be at point E, as indicated here, where marginal revenue equals marginal cost. Right, looking at production, profits, losses, and supply. Production and supply for the business, the maximum profit will be, as we indicated before, marginal cost equals marginal revenue. And this is used to derive the business's supply curve. So in other words, when you look at the point where marginal revenue equals marginal cost, that is going to give you an indication of what your supply should be. Take different market prices and determine how much business would produce at each price. In other words, production determines supply. look at the market price, see what the demand is for the product, and then determine what your supply is going to be. In a normal market, perfect market, as we are discussing here, if you are going to try and produce something that there's no demand for, people will just not purchase, and eventually you will have to reduce your production or even stop your production. Right, the next step would be to add the average variable costs. In other words, when we look at variable costs, it's important that you remember it's those things that will be different for the different quantities that you produce. So if you produce nothing, you will still have certain fixed costs, but your variable cost will change. If you produce 10 units, then your variable costs will increase. So those are the things that you have to keep in mind. So your labor cost, material cost, fuel, and electricity are all things that will differ as you produce different quantities. Right, the next graph indicates that the market price rises due to an increase in demand. So in your normal market, the complete market situation for the perfect market, as there's an increase in demand, and what we see in this example, there's D1, so this is where we start with our original supply curve. Price is going to be P1. As demand increases, and that is for any other reason but not because of a change in price, you will have a new demand curve to the right, so it changes to that side, and as a result of that, you will also have a new price. So as demand increases and supply remains the same, the price will increase from P1 to P2. If there's an even further increase in the demand, for any reason but not price as a reason, there will be a completely new demand curve to the right, and this will lead to an even higher price to the product, so price will increase from P2 to P3. At the different quantities, which you can give your own labels to, Q, maybe Q1 and Q2. So this is what happens in the industry. When you look at the individual, the prices will increase. In the discussion, it says horizontal demand curve for the business's product shifts upward. So as you can see, the demand curve and the price curve is the same thing. It will shift upwards, intersecting short-term marginal cost curve. So I want to go back there. There's the marginal cost curve. Those are the different equilibriums. At the point to the right of the previous point of the intersection. So what they are saying is, as the prices increase or the demand increases, the equilibrium will move from the left, from E to E1 and from E1 to E2. And each one of these points on the different prices show where the profits will be maximized, where marginal cost equals marginal revenue. Point E plots the business's supply at the different market prices. The supply begins at E. So if I go back to the graph to just show you what happened there, point E. As there's an increase in the price or then an increase in the demand, it will move to E, from E to E1, from E1 to E2. The individual business. Equilibrium positions for the individual business. In a perfect market, the individual business faces a perfectly horizontal demand curve. As I showed you earlier on, the demand curve looks like this. And that it's exactly the same as the price. So quantity at the bottom, price on the side. You do not have any influence on the price. So no matter what the quantity will be that you're going to sell, you can only sell it at that specific price. Market price is determined by the industry. In other words, what happened in the industry? In the industry, prices were determined by the interaction of demand and supply. and you are limited by the prices that are determined in the market. Again, quantity at the bottom, price on the side. You will see that some of the facts are actually repeated. It is just that when they set the memo, they actually use different textbooks and maybe a little bit of a different approach. And this memo is there to actually make sure that all the textbooks are covered. Again, as we said before, individual businesses are price takers. In other words, they're not able to influence the price. And what does the individual do? He can increase or decrease his output in order to maximize the profit. So the only thing that you can do to maximize your profit, to make more profit, is to increase your production. Profit is maximized. Again, you will see we mentioned it earlier on, where marginal revenue equals marginal cost. This is the point at which the profit is maximized, which is known as the equilibrium. Again, in this graph, so this is just a different way of saying the same thing. Marginal cost equals marginal revenue at that point. So E1 will be profit maximization. And if you have to indicate the price, it will be P1. It doesn't have to necessarily be a specific amount. Equilibrium is at E1. In other words, the firm will produce where marginal cost equals marginal revenue. That's worth 2 marks. At this point, Q1. Now, I just want to go back so you can see where Q1 is. So that is the price, and this is the quantity that we are referring to. Average cost for Q1 units is point R on the average cost curve. This is point R. And the price or the average revenue is greater than average cost. It's important that your revenue must be bigger than your cost. So total revenue will be bigger than total cost. Then you are making a profit. Therefore, economic profit is represented by the area. And we need to go back to see where that area is. Economic profit is represented by this area. What we see here is that normal profit is made at the point, and be sure to indicate exactly whether you are referring to normal profit or economic profit. Make sure that you label the graph correctly. Again, where you find marginal cost and marginal revenue is the same. I also want to discuss with you how to indicate economic loss. Going back to the memo, I see that the business makes normal profit, which is the minimum earnings required to prevent the entrepreneur from leaving or using the factors of production elsewhere. In other words, when you look at opportunity cost, if you have to decide between 2 different possibilities, you will not continue to produce if you do not make normal profit in the perfect market. Looking at the graph here, the equilibrium is at E1, as we've indicated before. The firm will produce, again, where marginal revenue equals marginal cost, which is at point E. At this point, Q1 goods are produced at a price of P1. So there's your quantity, there's the price. So this is where you operate if you want to make normal profit. At equilibrium point E1, price or average revenue is less than the average cost. So you have to look at E1, which they did not indicate here. So that is E1. At that level, you can see that there's your average cost is higher than your average revenue. So there's a gap between that, which means that you're actually not covering all your costs. And it does make sense that if your costs are more than your income, that would not be worth your while to run that business. It says here at equilibrium point E1, price or average revenue is less than average cost, or the average cost curve lies above the demand curve, which means that price or average revenue is smaller than average cost, and that means that total revenue is smaller than total cost. So that is very important. If you don't get enough income, the business will not be profitable. So in this case, the business makes economic loss, and the economic loss is actually indicated in this area. So anything between the average cost curve and the average revenue curve. We've now reached the end of the essay. It is very important that you remember to write a conclusion. Do not write that you have discussed the following topic. Be very clear that you have come to some conclusion on that specific topic. In other words, freedom of entry and exit into the perfect market alter the supply of goods on the market. What this means is, because there are no limitations on entering the market or exiting the market, there will continuously be a change in the supply of the product in this market. This results in changes to price. So in other words, because there's an increase in supply, or if there's an increase in supply, prices will drop. If there's a decrease in supply, prices will rise. This results in a change in the price, which influences the profit or the loss of a business. So the business is continuously influenced by what happens in the market as the business operates as a price taker. Something else that you can mention in your conclusion: if the price falls to a level where it is equal to the average variable cost, then the firm will shut down. I hope that what you've learned here today has been meaningful and that it will help you when you write your next exam paper.